Hi friends, welcome to this latest video on NISM-Series-XXI-B Portfolio Manager Certification Examination. In this video, I'm going to take you through 30 questions, and these are in form of MCQs. Now let me also tell you that while these questions may not directly get asked in the exam, they cover some important concepts uh, that you can learn from these questions, and then also apply while you are asked questions related to similar concepts. But before I move ahead, let me just tell you that it will be great if you subscribe to my channel and also like this particular video. I'm sure you like the content of the video, but it will be great if you like the video also. So let me start and take you through the questions one by one. So the first question is about mutual fund. So the question is, performance advertisement of mutual fund schemes shall be provided in terms of CAGR, which is compounded annual growth rate of past 1 year, 3 years and blank. Okay, which how many years and since inception along with their respective benchmark. So the answer here is 5 years. So the answer would be A. So you get to see 1 year, 3 year and 5 year return of the mutual funds. The next point is, what is the total expense ratio limit for an equity mutual fund on the first 500 crores of their daily net assets. Now this is the limit which is allowed as per SEBI guidelines, and this happens to be 2.25%. So that's why the answer is C. Now I move on to the third question, and third question is related to the legal structure of portfolio manager and what are the portfolio management services which is provided. So portfolio portfolio management services has to be provided by a body corporate. Now it can have different legal structures. It can also have a limited liability partnership structure, but not a partnership structure technically speaking. So the answer here would be D. Let me move on to the question, which is the question 4 now. It's about a kind of an officer which is required to be part of the portfolio management organization which is providing the portfolio management services, and this means an employee of the portfolio manager who has been designated as such by portfolio manager and has certain responsibilities which are related to decisions made by the portfolio management manager for the management or the administration of portfolio services or the funds of the client, as the case may be, and all other operations of the portfolio manager. So this activity typically is done by the principal officer. So the answer would be principal officer in the previous question. Now what is the net worth requirement for the portfolio manager in India? Which means if you are a portfolio manager, in order to be eligible to provide the portfolio management services, what should be your net worth? So the answer here is B, which is 5 crores. This should not be confused with what is the minimum amount of investment which is required if you wish to avail portfolio management services. That's a separate question. Which of the following statements is not true in case of sale and purchase of securities by portfolio manager for its clients? So how can portfolio manager do sale and purchase of securities for its clients? The portfolio manager shall ordinarily purchase or sell securities separately for each client. That is the option 1, and that seems to be something very, very logical. Aggregation of purchases or sales across the client is not allowed. Can a portfolio manager aggregate purchase and sales across client? Now this is a very tricky one, so we'll come to it at a little later stage. The third one is that the portfolio manager shall not keep any open position in respect of allocation of sales or purchases effected in a day. So he should not keep open position, he should settle all the accounts. And the final point is that the portfolio manager shall not, while dealing with the client's fund, indulge in speculative transaction except for derivatives transaction. So essentially here, if you see all the 4 options, aggregation of purchase of sales across client is actually allowed because of economies of scale reason, and that is something which is permitted. So the answer here obviously is B. Now I move on to question number 7, which is, as a portfolio management services, you can provide different types of services. Provide a discretionary services, non-discretionary, also advisory. In case of advisory services, fund is not being managed, only advice is being given. Discretionary and non-discretionary are self-explanatory in terms of who will take a call about investments. So which of the following is not a valid type of portfolio management services? Obviously the client specific services, which is D. Now I move on to question number 8, which is, what is the exit load applicable in case client portfolio is redeemed after 3 years in portfolio management services? So you are waiting for 3 years and then you are asking for a redemption. So what could be the charge that would be applicable? The answer here is nil. So after 3 years, there's no charge that you pay in form of exit load. So that's the answer here. We move on to question number 9, which is the portfolio manager is required to preserve the books of accounts and other records and documents for preceding how many years. So that's the fill in the blanks. Now typically, this requirement of number of years could be very standard, and here it is 5 years. This 5 years could be the case in many scenarios, but here it is obviously 5 years. We move on to question number 10, which is explained itself here. Portfolio managers cannot use off-market transactions. Now, what is off-market transaction? Off-market transaction is a transaction which is happening outside the stock market. It's being mutually done by two parties, between two parties. It's a kind of an OTC transaction, and there's no STT that is paid on such transactions. So portfolio managers can use off-market transaction. It is not that they can't, and that's why this statement is false. Question number 11 is, which of the following calculation method is used for disclosure of performance under discretionary portfolio by portfolio manager? So if you have to calculate the return and present it, which method will you use? So obviously the method used is time weighted rate of return, which is TWROR. Now let me tell you that why I have put this particular question here is that many times you need to not only know the method but also need to understand how the calculation happens under TWRR, which is time weighted rate of return. So I would suggest that you work on the calculation also of TWRR to understand this, and other calculations also, money weighted rate of return, arithmetic mean, and compounded annual growth rate. Answer obviously is A. Let me move to the 12th question. So it says, as per SEBI Portfolio Managers Regulation 2020, by when should the disclosure document be shared with the client? So you have to share a disclosure document with the client, and it can be shared at any time before or at any time of entering into the agreement. Okay, so the answer here would be D. It's not specifically after X number of days. That's the specification that has been provided here. Question number 13 is, which part of the disclosure documents does the statement past performance of the portfolio manager does not indicate its future performance belong to? Which means, this is a typical disclaimer kind of a thing, that because there was a performance in the past, it may not essentially get replicated in future. Now this is something which is part of the risk factors. So the answer is A. Question number 14, NRIs can invest in portfolio management services. Is this true or false? NRIs can definitely invest in portfolio management services. They have to follow certain KYC requirements which are different from the KYC requirement for resident individual. Also, they need to follow the FEMA guidelines. So this is a statement is true, this particular statement. Question number 15 is, but portfolio managers shall take adequate steps for redressal of grievances of investors. So redressal of grievances of investors has to be done by the portfolio manager within X number of days, and that is 30 days. So 1 month is the answer here. A is the answer. Question number 16 is related to an institution called as FIUIND, which is Financial Intelligence Unit India, and any suspicious activity related to the financial transactions have to be reported to this particular entity. Okay, and all the capital market intermediaries have to report that. So what is the time limit within which suspicious transaction should be reported by portfolio manager, which is also accountable to report it as per Prevention of Money Laundering Act in India, and also as per the guidelines set by the market regulator? So the answer here would be 7 days. The next question is related to contribution made by a client for the first year is 1 crore to PMS. This amount rises to 1.2 crore in the first year and falls to 1.1 crore in the second year. So on what amount will the performance fee be calculated in the second year? There would be no performance fee in the second year because the returns have been negative. That's why the answer here is D. Now the next question is, the minimum investment required for PMS is how much? So if you are availing PMS services, how much money that you need to put into a PMS? It's 50 lakhs, and that's why answer has directly been given as A. The next question is, which of the following is the first step in the portfolio management process? So when you initiate the portfolio management process, what are the steps that you need to follow? So the answer obviously is development of policy statement for the portfolio, which you will need to do. Study of current financial conditions and forecast future trends should be a subsequent step. Construction of portfolio will definitely also be at a later stage. And portfolio management process is performance measurement and evaluation. That's not a valid option. So the answer is A. Move on to question number 20. So under liberalized remittance scheme in India, resident Indians can take out $250,000 outside India for investments. Now there is a limitation that RBI has put that you cannot take more than $250,000 in a financial year. Now what kind of a constant is this? So if you see, it's a constant which is a regulatory constant, because it is something which the regulator has put in place. So the answer would have been regulatory there. What is the geometric mean of return of an investment if the first year return is minus 20% and the second year return is 25%? So let me tell you that geometric mean would kind of handle the limitation of arithmetic mean here. Arithmetic mean will give minus 20 plus 25, which is 5%, and 5% divided by 2 would be 2.5%. So here, as per arithmetic mean, it would be 2.5%, but as per geometric mean, it would be 0. So you can calculate the geometric mean return by writing the formula 1 plus R1 into 1 plus R2, which is 2 years return, in bracket raised to 1 by 2 minus 1. That's how we'll get the answer for this particular question. The next question is, it is the standard deviation of difference between portfolio and its targeted benchmark portfolio return. So this particular thing is tracking error. We call it as tracking error. So that's what tracking error is all about. We move on to question number 23, which is about calculation of duration. So you can calculate duration in Excel, and to calculate that you will need parameters such as settlement date, maturity date, yield, face value, coupon, frequency, and basis. Basis means how many days in a month and how many days in a year. So we follow a day count convention. In capital market in India, the day count convention followed is 30 by 360. In money market, it is actual by 365. So see this particular calculation, there's a right hand side, there's a question here. Based on the information given in the table, in the left hand side, calculate the duration of the bond. If you use function duration in Excel, you will get answer as 4.62. And we move on to the next question. What would be the Sharpe ratio if annualized standard deviation of the portfolio is 6.5? So there is a standard deviation which has been given. Annualized return for same portfolio is 10.5 and the risk-free rate is 5.5%. So in the numerator we will write 10.5 minus 5.5, which is 5%, upon 6.5, and if we solve this we will get an answer which is 0.7692. Question number 25. Which of the following fees should be deducted first while calculating net return of a portfolio? Now an important thing to note here is that when you calculate the net return and gross return, and there is a calculation given in the book also, which is the NISM Portfolio Managers book, you must be very clear that when you calculate the net return, the first thing that you deduct is upfront fee. Okay, and then you subsequently deduct other things. This is different from calculation of high water mark. So please have that in mind. The next question is that even the first period return of a fund is 2%, second is 6%, third is 11%, and fourth is minus 3%. What is the TWRR of the fund? Now this calculation will happen through 1 plus first year return multiplied by 1 plus second year return multiplied by 1 plus third year return, similarly multiplied by fourth year return minus 1. Okay, that is what will give you the return, and that return will translate into 16.41%. Now, if the value of the fund increases from 10,000 to 20,000 in 5 years, then what is the CAGR of return? Now, CAGR of return can be found in Excel very easily by using the function IRR. So use the function IRR and you will get the answer in this particular case, which would be 14.86. Alternatively, you can use the formula, which will be as follows: 20,000 upon 10,000, which is 2, obviously, raised to 1 upon 5 minus 1. So raised to has to be put under bracket when you are using the calculation of this particular formula. Question number 28 is which is the underlying of commodity options contract in India. So basically, commodity options contract in India are created on commodity futures. So the answer would be A. 29th is I believe that a high profile manager would generate better return and hence it makes good investment is an example of stereotype investing, which means we are often influenced by the fact that if there is a fund manager, it's essentially high profile, so it will generate a good return. And finally, the last question, it is an information processing bias in which a person answers question differently based on the way it is asked. So if I change the framing of the question, it will give me a separate answer. That's why the answer is A. I'm sure these 30 questions made sense for you. As I said in the beginning, I'm repeating again. Please do like this video and subscribe to my channel. Thank you so much for your valuable time.